If you're building a mobile app or a tech startup as an LLC because a business formation service or a blog post told you that it was simpler for taxes, you might have just signed away a $15 million tax-free payday. I'm serious. In the startup world, everyone talks about growth, fundraising, and code, but almost no one talks about Section 1202, a legal tax shelter that Congress built specifically for technology innovators. It's called QSBS, or Qualified Small Business Stock. Under the updated rules, it allows you to completely wipe out up to $15 million in federal capital gains tax when you eventually sell your company. But here's the catch. It's an all or nothing game. If you don't structure your business perfectly from the very beginning, you are locked out. Today, I'm pulling back the curtain on how this works, why your standard LLC might be a mistake, and the potential very real drawbacks of a C-Corp that you need to consider before making the switch. In 2026, I had consultations with 3 different app founders. Each of them have used a business formation service to form their LLC. Now, there are a few business formation services you have definitely heard of. I won't say their names, but what they do is help you form an LLC. They are not attorneys or accountants. Their job is to sell you LLCs and then submit documents to your state. Each of these 3 app founders would have been way better off having formed a corporation, not an LLC taxed as a corporation. Now, let's talk about the $15 million prize you get if you do this correctly. Thanks to recent tax law changes under the One Big Beautiful Bill, or OBBBA for short, the stakes just got much higher. For any qualified stock issued after July 4th, 2025, Congress raised the maximum tax-free gain exclusion from $10 million to either $15 million or 10 times your original investment basis, whichever is higher. Before this law passed, you had to hold your stock for a rigid 5 years to get a single dollar of this benefit. If you sold at year 4, you paid full tax. But the new law introduces a tiered approach that fits the rapid timeline of an app founder. If you hold the stock for 3 years, you can exclude 50% of your gain from federal tax. Hold it for 4, you exclude 75%. If you cross that 5-year mark, a full 100% of your capital gains are completely tax-free. For app founders building to a rapid exit or acquisition, this changes everything. So, what is required from the outset? First, your company must be a domestic C corporation. S corporations do not qualify. Standard LLCs do not qualify. Now, if you already formed an LLC, you might think, no big deal, I'll just convert it to a C Corp right before I sell the company. Sorry, it don't work like that. To qualify for this tax-free treatment, you must have acquired the stock at its original issuance directly from the corporation. If you spend 3 years building your app in a partnership LLC and then convert to a C Corp, your tax clock doesn't start until the day of that conversion. Now, can you get around this if you have an LLC but choose to be taxed as a C Corp using an IRS check-the-box election? Technically, yes. The IRS allows LLC units to count as stock if you file Form 8832. But structurally and legally, if you plan to scale, raise venture capital, or bring on investors, an LLC treated as a C Corp is a messy headache. Real investors want a clean corporate framework. The ideal business model for this is a technology company building an asset like software or an app. Now, the tax code explicitly excludes service businesses like law firms, medical practices, consulting agencies, where the value is tied to a person's skill. An app is intellectual property, making software, the startups, the gold standard for QSBS eligibility. All right. There are drawbacks of a C Corp. Let's be honest, the C Corp is not a magic fix-all. First, you face double taxation. An LLC is a pass-through entity. The business profits flow straight to your personal tax return, and you are taxed exactly once. A C Corp, however, is a separate legal entity that pays a flat 21% corporate tax rate on its net income. Now, if you want to pull money out of that C Corp to pay your personal rent or buy groceries, you have a few options, but none of them are free. If you pay it out as a corporate dividend, that cash is taxed twice, once at the corporate level and again on your personal return. If you try to bypass that by paying yourself a salary, the corporation can deduct it. But you now have to pay standard personal income taxes plus 15.3% in employment taxes on that salary. And if you try to just borrow the money as a shareholder loan, the IRS watches that like a hawk. If you don't pay it back at market rate interest, they will reclassify it as a disguised dividend and hit you with penalties anyway. The bottom line is, If your app's business model is designed to generate monthly cash flow for you to pull out and spend on your lifestyle, a C-Corp will cause a massive tax drag. A C-Corp often only makes sense if you plan to reinvest 100% of your profits back into hiring developers, marketing, scaling the asset towards a massive exit. Second, the administrative overhead is real. LLCs are simple to run. C-Corps require formal corporate bylaws, annual shareholder meetings, documented board minutes, and entirely separate, complex corporate tax returns. If you're a solo founder launching a simple app as a side hustle, the legal and accounting fees alone could wipe out any theoretical tax benefit. The takeaway here is simple. Your business entity choice on day one should match your exit strategy. If you are building a lifestyle app to generate a steady personal income, maybe you stick with a pass-through LLC. But if you're building an app to scale, raise capital, reinvest every dollar, and sell the company for millions in a few years, a C-Corp is the only way to shield your hard work from the IRS. Don't guess on your entity structure. Changing your mind 3 years from now can reset the tax clock and cost you millions. I know just enough to be dangerous regarding Section 1202 stock. Click the link below to book a consult, and let's make sure you're building on the right foundation. Thank you for watching. Please like and subscribe, and don't let a bad entity choice ruin a great exit. Start planning.